Now that we are familiar with the fundamentals of risk and return, modern portfolio theory, and the main implications of the Harry Markowitz theory based on two-fund separation, now it's time to go further and consider the capital asset pricing model, or CAPM, which is more frequently used by researchers and market practitioners in order to determine the relationship between the risk and return. At the beginning of our lecture, we'll formally derive the capital asset pricing model based on the Markowitz model, and then we'll talk about the key theoretical implications of the CAPM. We'll then proceed by talking in detail about the main approaches to determining the key unknowns in this model, which we use in order to determine the expected return. Finally, we'll focus on the critical arguments against the CAPM and the empirical evidence for and against this model in order to see how the forecasts fit reality. Finally, we will talk about several modifications of the CAPM frequently used in practice, which may help us better estimate the expected returns based on this model. So let's get started. This is William Sharpe, the Nobel Memorial Prize in Economic Sciences winner in the year 1990. By the way, he shared this award with Harry Markowitz. He is famous for his research papers on the capital asset pricing model published in 1960s, as well as the fundamental book called Investments, where he summarizes all the theories in financial science which help us evaluate various types of financial assets. And he is also known as the developer of the capital asset pricing model we are going to talk about today. Sometimes this model is also called the Sharpe model, after William Sharpe. In order to start, let's remind ourselves about the key implications of the Harry Markowitz model. As we remember, the optimal set of portfolios lie on the capital market line, where all the investors hold the combination of the risk-free asset and the tangency portfolio, which is the optimal portfolio of risky assets available in the market. By the way, if all investors have homogeneous expectations, which is one of the assumptions of the model, then each investor will identify the same portfolio as having the highest Sharpe ratio in the economy. Thus, all investors will demand the same efficient portfolio of risky securities, which is the tangency portfolio, adjusting only their investment in risk-free securities to suit their particular appetite for risk. However, if every investor is holding the tangency portfolio, then the combined portfolio of risky securities of all investors must also equal to the tangency portfolio. Furthermore, because every security is owned by someone, the sum of all investors' portfolios must equal the portfolio of all the risky securities available in the market, which we define as the market portfolio. Therefore, the efficient tangent portfolio of risky securities, or the portfolio that all investors hold, must equal the overall market portfolio. The insight that the market portfolio is efficient is really just a statement that demand must equal supply. In other words, all investors demand the efficient portfolio, and the supply of securities is the market portfolio. Hence, these two must coincide. If a security were not a part of an efficient portfolio, then no one will be holding that, and the demand for this security will fall. the security's price will fall, causing its expected return to rise until it becomes an attractive investment. In this way, prices in the market will adjust so that the efficient portfolio and the market portfolio coincide and demand will equal supply. Here is the equation for the capital market line, showing the relationship between the expected return, which is the dependent variable, and the standard deviation of the portfolio, which is the independent variable. And we see that the standard deviation of the portfolio is multiplied by the Sharpe ratio, which determines the slope of the CML. In the current context, this equation is assumed to describe a closed system within which the value of a single dependent variable is precisely defined by the values attributed to 4 independent variables. The model derives its validity from the algebraic logic, as opposed to the verifiability or plausibility of attributed values, whether realized or expected. It explains the assumed risk-return characteristics of efficient portfolios, while providing a platform from which to derive the capital asset pricing model. As we see, the capital market line contains only efficient portfolios and assets. However, there are many others available in the market. Efficient portfolios plot along the capital market line and are perfectly correlated with the market portfolio. In other words, we can say that the correlation ratio of such portfolio with the market portfolio equals 1. However, as we know, there are many other assets which do not lie on the capital market line. And now we are going to generalize this relationship and include any other assets which are available in the market. So let's extend our equation for CML in order to define the return on any portfolio as a function of its total risk. Now we introduce the correlation ratio between the return of a portfolio and the return of the market portfolio, which will be multiplied by the Sharpe ratio. And now, by doing some workings with this equation shown, we can finally result in the following equation, where the expected return on the portfolio should be equal to the risk-free rate plus the difference between the market return and the risk-free return, which we will further define as the risk premium, by the covariance of the returns of our portfolio and the market portfolio, divided by the variance of the market portfolio. The last part of equation is called the beta coefficient, and this is the ratio which shows the sensitivity of return of the given portfolio to that of the market. Now we have worked out the basic equation for the capital asset pricing model, which may help us estimate the expected return of a given asset, knowing its relationship with the volatility of the market portfolio. Finally, let's remind the key assumptions of the capital asset pricing model, which we'll use when defining the expected return of a security. The capital asset pricing model is based on the Markowitz model, which implies that all the assumptions behind the Markowitz model also hold for the Capm. However, there are some extra assumptions that we need to make. For example, we need to state that now all investors carry diversified portfolios over a broad range of securities. In other words, the firm-specific risk, which is estimated in the Markowitz model along with the market risk, is not priced by the capital asset pricing model. This is only the market risk which drives the expected return of the asset in the framework of the CAPM. We also need to keep in mind that all investors have perfect information and homogeneous expectations, which also drives their solutions and investment decisions just in the same way. And we also need to mention once again that all investors should be price takers and cannot influence prices on their own, and can lend or borrow unlimited amounts at the risk-free rate, which is the same and stable for all the investors who operate in the market. Finally, we also need to assume the infinite divisibility of all the assets available in the market and perfect liquidity. So here are all the assumptions of the CAPM, which again drive us more towards the concept of a perfect market. However, we need to keep these assumptions in mind when talking about the theoretical implications of the CAPM. In this section, we'll consider the theoretical implications of the capital asset pricing model. The CAPM formula you can see on this picture is used for calculating the expected returns of an asset. This is based on the idea of systematic risk, otherwise known as the non-diversifiable risk, which investors need to be compensated for in the form of the risk premium. A risk premium is the rate of return which is greater than the risk-free rate. When investing, investors always desire a higher risk premium when taking on more risky investments. As we know that the risk-free rate and the return on the market portfolio is equal for all investors who operate at this market, then the capital asset pricing model is a linear one-factor model, where beta is the only unknown which determines the expected return of each given security or portfolio. Let's take a look into the beta ratio in more detail. The beta, which is the covariance of the returns for an asset with the market portfolio divided by the market portfolio variance, is the statistical measure of a stock risk, also known as the volatility of returns, which is reflected by measuring the fluctuation of its price changes relative to the overall market. In other words, this is the stock's sensitivity to the market risk. How do we treat this indicator? For instance, if the company's beta is equal to 1.5, then the security has 150% of the volatility of the market in average. However, if the beta is equal to 1, then the expected return of a security is equal to the average market return. A beta of -1 means that the security has a perfect negative correlation with the market, and the beta of 0 is the risk measure for the risk-free portfolio. The capital asset pricing model equation can be graphically represented by the security market line, which can be composed by knowing the risk-free rate and the return of the market portfolio. As we can see, the risk-free rate has the beta of 0, and the market portfolio has the beta of 1. And the higher the sensitivity of an asset or portfolio to that of the market, the higher the expected return is. As we have already mentioned, the capital asset pricing model is the equilibrium model, which implies that the demand for investments equals the supply. However, it may not be the case in any particular moment. And now let's consider what happens if some investments are out of the security market line for some reason in a given particular moment. For example, let's consider stock A, which lies above the security market line. What does that mean? As it follows from the Capm, we can see that this stock is currently traded at the expected return higher than forecasted by the model. This implies that you can earn more by investing in this security carrying the same level of risk. As you can earn more by investing in this security, this stock is relatively underpriced compared to the alternative investments with the same risk. This implies that buying this stock is a good strategy which may help us achieve a higher return with the same risk. As the market contains all investors who have perfect information and homogeneous expectations, then these will be noticed not only by you, but by any other investor in the market, so that everyone will be willing to buy stock A, thus increasing the demand for this stock and moving its price up. As stock A increases in price, then its potential return will be going down, thus moving this stock back to the SML until it reaches that line. And so we can say that in this case, the market will reach equilibrium again. The opposite logic can be applied to stock B, which currently can be found below the SML. This stock is likely to be overpriced for the same reason as explained before. We can see that this stock shows a lower return compared to alternative investments lying on SML, which means that we can earn less at the same level of risk compared to alternative investments if we choose stock B. Again, all investors would notice that and will start short selling stock B, thus moving the supply for this stock up and the price for this stock down until it reaches the price corresponding to the expected return equal to that as predicted by the model. So the capital asset pricing model implies that even though short-term discrepancies may occur, in the long run, the market tends to reach equilibrium. There is one more interesting thing I would like to talk about when describing the theoretical implications of the capital asset pricing model. If you are a passive investor and you are holding an investment portfolio, in the long run you will be achieving the average return, which corresponds to the expected return forecasted by the Capm, which can be worked out by using the portfolio beta. So that's why beta is another word for the long-term return of a passive investment portfolio corresponding to its sensitivity to the market return in general. However, you can get engaged in active portfolio management by buying and selling the stocks which tend to be relatively under or overpriced compared to that forecasted by the market, just the way I showed you in the previous slides. This type of return that you may be achieving by doing such active portfolio strategies is called alpha. Seeking alpha is one of the greatest incentives for traders and portfolio managers to seek underpriced stocks and include them into the portfolio. However, applying this strategy carries high risks because it's not so easy to outperform the market. And there is some statistics which prove that. Here on this picture, you can see the share of actively managed equity funds in the United States whose returns exceeded the corresponding target index. As you can see, the proportion of successful funds depends on the time horizon. And even though about 40% of the actively managed funds managed to beat the market at the horizon of 1 year, only 12% succeeded at the horizon of 40 years, which means that S&P 500 is indeed a very tough rival, and sometimes it's better to stick to passive portfolio management rather than to seek alpha. So now let's summarize the key findings of the Markowitz model in contrast with the key outcomes of the Capm in order to see in which respect these models are different and in which respect they are common. As we can see, the main indicator of risk in the Harry Markowitz model is the standard deviation of security returns. This is the measure of the overall risk, which contains both the systemic and non-systemic risk. However, the risk metric in the Capm framework is beta, and this is the measure for market or systemic risk only. The CML, which is the efficient portfolio set in the Markowitz model, is the line where all efficient investments can be found, and each of these efficient investments is the combination of the tangency portfolio and the risk-free rate. However, the Capm implies that all assets and portfolios available in the market lie on the security market line, and this line includes both efficient and non-efficient investments. Here on this picture, we can have the graphical interpretations of these two models compared. And it's very interesting to see that the securities which are not efficient in the Harry Markowitz model can be found on the SML just like this. And the tangency portfolio is another word for the market portfolio when we move to the capital asset pricing model. So here are the key takeaways of the Capm. The first one follows from the Markowitz model and states that the market portfolio is the efficient portfolio. Therefore, the highest expected return for any given level of volatility is obtained by a portfolio on the CML, which combines the market portfolio with the risk-free lending or borrowing. However, the risk premium for any investment is proportional to its beta with the market, which is the key implication of Capm as the linear one-factor model. And therefore, the relationship between risk and the required return is given by the security market line. Now that we are familiar with the theoretical framework and key implications of the capital asset pricing model, let's take a look how this model is used in practice when estimating the expected returns of various financial assets. As you can see from this equation, which I believe you already remember, we have three unknowns in this formula that will influence the expected return of an asset. The first one is the risk-free rate, the second one is the return of the market portfolio, and the third one is the beta of an asset, which in turn is determined by the covariance of the asset return with the market as well as the variance of the market portfolio. So now let's discuss all these unknowns one by one in order to understand how we can estimate them in practice. We'll start with the risk-free rate. Typically, risk-free rate is equal to the yield of a 10-year US government bond if we estimate the returns at the American market. Of course, the risk-free rate should correspond to the country where the investment is being made, and the maturity of the bond, in theory, should match the time horizon of the investment. Professional convention, however, is to typically use the 10-year rate no matter what, because it's the most heavily quoted and the most liquid bond at the national debt market. Another unknown is the market return. Of course, it's very hard to measure the market portfolio, and that was one of the reasons why the Capm was criticized. I will talk about this a bit later. However, we need to measure the market return. That's why we need to look into some proxies. Of course, no need to argue that one of the most obvious and commonly used proxies for the market return is the broad market index, which contains a relatively big number of the most liquid stocks available at the national market. And of course, you need to keep in mind that just like in the case of the risk-free rate, you should use the market index which corresponds to the national market you are operating in. For example, you should use Dow Jones, Nasdaq Composite, or S&P 500 when you estimate the expected return at American market using the Capm. However, you should use DAX at the German market or FTSE at the British market. The biggest problem in estimating the expected returns using the capital asset pricing model is about the estimation of beta. As we can see, the beta coefficient is based on the covariance of the asset returns with that of the market return. Or, in other words, it can be identified by using a linear paired regression. And just in case with any type of regression, we are facing some estimation problems. For example, the Capm does not specify which return frequency should be taken. For example, should we use daily, weekly, or maybe monthly returns in order to measure the expected returns? Moreover, we are uncertain about the time horizon which we will need to take. For example, should we use the information about the historical returns for the recent 1, 3, 5, or maybe 10 years? Unfortunately, the theoretical model contains no answer to this question. That's why you need to use a trial and error method in order to estimate the beta based on historical data, which will best fit the statistical significance indicators. Just like demonstrated on this slide, you can adjust various parameters of this linear regression to find the combination which will result in the highest R-squares or in the lowest p-value. And thus, our estimation of beta can be trustworthy. However, in turn, this does not guarantee that the beta estimated using historical data will be sustainable in the future. So there is just another problem of estimating beta as a measure of a security risk. The capital asset pricing model was introduced in 1960s, and since then it has been frequently tested by both researchers and investors. Very soon it turned out that the returns estimated by the capital asset pricing model do not fit the actual returns accurately. So there were some estimation errors. And of course, all the researchers were interested where these errors come from. And there has been lots of arguments against the CAPM as well. One of the most famous arguments was proposed by Roll in 1980s, and it's based on the criticism of the estimation of the return for the market portfolio. The main idea is that the CAPM, which is based on the Markowitz model, implies that a market portfolio contains all the assets available in the market, which are not only limited to the publicly traded stocks, but also contain fixed income securities, commodities, shares in non-public companies, real estate, and even human capital. That means that practically the market portfolio is not observable, as it includes a big number of assets, and most of these assets are very difficult to evaluate, especially at the daily basis. So that's why, as a rule, we take various stock indices as proxies for the return of the market portfolio. But indeed, there is no proof that by observing the dynamics of various stock indices, we can observe the changes in the real returns of the market portfolios. So in other words, we can say that the true market is not observable. And that's why the capital asset pricing model cannot be efficiently tested in practice, because we cannot say what influenced the returns in reality and what was the real true reason why the return forecasted by the CAPM did not fit the actual return. In other words, we can describe the Roll's critique of the CAPM as the following dilemma. Once the actual return does not correspond to the expected return calculated based on the CAPM, we can propose that maybe the reason is that the proxy for market return is chosen incorrectly, and maybe we should look for some other proxy for the return of the market portfolio, which will make a better estimation of the expected return. However, it may also be the case that the proxy for the market return is alright. However, the CAPM in general is not valid in relation to the chosen asset or this market overall. And the problem is that we never can tell. Practically, even if the expected return equals the actual return, it can be the consequence of a double mistake, meaning that we may choose the incorrect proxy and the CAPM is not valid. However, by coincidence, we have received the correct forecasts. There is one more interesting thing about the empirical testing of the capital asset pricing model, which I would like to show you. We can see that the empirical security market line has a smaller slope compared to the theoretical security market line. And there is quite a lot of papers which prove this idea. In other words, if we take a big observation period, for example from 1931 to 2008, and group all these securities in 10 portfolios, where portfolio 1 includes the securities with the lowest betas and portfolio 10 includes the securities with highest betas. By observing their actual return and comparing them with their forecasted returns, we can see that the capital asset pricing model overestimates the expected returns for high beta stocks. However, at the same time, it underestimates the expected returns for the stocks with lower risks and lower betas. Thus, the empirical security market line is somehow steeper than the theoretical one. And if we divide these periods into two sub-periods, we can see even a more interesting picture. We can see that for the observations between 1931 and 1965, generally there was a relatively narrow gap between the empirical and the theoretical security market lines. In other words, we could say that until 1965, the capital asset pricing model did its job well. However, things changed starting 1966, when we can observe larger gaps between the actual and forecasted returns. Maybe one of the possible reasons is that 1965 was the first year after the announcement of the capital asset pricing model by William Sharpe, meaning that William Sharpe himself could only use the historical data up to 1965 or maybe 1964 in order to test his findings. However, after 1965, many researchers and, which is more important, investors started applying his model and thus making the predictions based on this model corrupt. So that's why it may be the reason why the empirical results for testing the CAPM have a worse correspondence to the theoretical forecasts in the second part of this period. And very soon there were some other anomalies which were undercovered. For example, it was observed and proved that small companies tend to generate returns higher than predicted by the CAPM. There was another anomaly for the blue chips companies, or the companies with low price-to-book ratios. They generate higher returns compared to growth companies with the same beta. We should also keep in mind the return autocorrelation, where we can use the historical return to predict future returns. All these anomalies were included into the further development of the capital asset pricing model, which I will consider in the next section of this lecture. However, some of them were also put forward in order to develop an alternative theory called the Fameux-French three-factor model, which I'm going to consider in my next lecture. The capital asset pricing model sets the theoretical framework for identifying the expected return of a security or portfolio. However, when it comes to identifying expected returns in the market practice, there is a number of factors we need to account for when identifying the expected returns. Here I would like to focus on several popular issues connected with the use of the outcomes based on the CAPM in the real market practice. The first thing I need to talk about is the beta adjustment. The thing is that the beta estimate based purely on historical data, also known as the unadjusted beta, is not a good indicator of the future. As a consequence of different choices in the time period used, intervalling effect and market index, different services adjust their regression betas towards one and use the adjusted beta to calculate the expected return. Research suggests that over time there is a general tendency for betas of all companies to converge towards one. Intuitively, it should not be surprising, because most companies tend to grow in size, become more diversified, and own more assets. Over time, their beta values fluctuate less, resulting in what is called beta-min reversion. Adjusted beta tends to estimate a security's future beta. It's a historical beta adjusted to reflect the tendency of beta to be mean reversing. So the Capm's beta value will move towards the market average, or 1, over time. Here you can see the formula which was proposed by Marshall Bloom in 1975. According to Bloom, there is a tendency of betas to converge towards the mean of all betas. He describes this tendency by correcting historical betas to adjust the beta to revert to 1, assuming that adjustment in one period is a good estimate in the next period. Another problem, which also holds for the portfolio theory, is that the historical volatility measures both the upside and the downside volatility. And the thing is that the upside volatility may not be considered as a big problem for investors. Indeed, there is not a problem if you get a higher return than you expected. The true problem is getting the return below the expected value. Thus, a beta is used as a part of the Capm, which is designed to calculate the overall expected return of the asset. While downside beta measures downside risk, or the possibility of negative movement, Capm can also be modified to include upside beta. Both upside and downside beta are defined as the scaled amount by which an asset moves compared to a benchmark. Downside risk is calculated on days when the benchmark's return is negative, while upside beta is calculated when it's positive. A capital asset pricing model that is based on international diversification of assets across different countries is called the global capital asset pricing model. Another name for it is the international capital asset pricing model. It incorporates factors that could influence pricing in the international context. This implies that investors do not only hold the local asset, but also a portfolio of globally diversified assets. Then, the market portfolio can be constructed using the assets from different countries and different markets and regions. This model of Capm takes into account such factors as inflation, transaction costs, exchange rate risks, and barriers to foreign investment in expected return computation. However, when it comes to investing in a particular overseas country, we need to adjust our expected return estimation by what is called the country risk premium. In general, by country risk premium, we mean the additional return demanded by investors in order to compensate them for high risk associated with investing in a foreign country, compared to investment at domestic markets. Overseas investment opportunities are accompanied by high risk because of geopolitical and macroeconomic risk factors that need to be considered. The country risk premium is generally higher for developing markets compared to developed markets. Here are the factors which account for the country risk. These factors include political instability, inflation risks, sovereign debt burden and default probability, as well as the fluctuations at the foreign exchange markets and some adverse government regulation, for example, the expropriation or currency controls. How can we estimate the country risk premium? There are two commonly used methods of estimating this premium. The first one is called the sovereign debt method. In this case, the country risk premium for a particular country can be estimated by comparing the spread on sovereign debt yields between the country and a mature market like the United States. Another method is called the equity risk method. Here, the country risk premium is measured on the basis of relative volatility of equity market returns between a specific country and some developed nation. Here you can see the screenshot from the Bloomberg screen where the country risk premium for different countries are estimated based on such factors as the historical dividend yield for the national stock market, the average growth rate, the dividend payout ratio, and the market return. We also take into account the risk-free rates, which are also different in each particular market. We can incorporate the risk premium that we have worked out into the capital asset pricing model using several different ways. The first approach assumes that every company in the foreign country is equally exposed to the country risk. While this approach is commonly used, it makes no distinction between any two companies in the foreign country, even if one of them is a huge export-oriented firm and the other one is just a small local business. In such cases, the country risk premium would be simply added to the mature market expected return, so that the CAPM equation would be modified in the following way. The second approach assumes that a company's exposure to country risk is similar to its exposure to other market risk. Thus, we add the country risk premium to the market risk premium like this. By using this method, we anticipate that the companies with higher betas are more exposed to the country risk than the companies with a lower beta, which is quite a reasonable assumption. Finally, the third approach considers country risk as a separate risk factor, multiplying the country risk premium with a variable which is generally denoted as lambda. In general terms, a company that has significant exposure to a foreign country by virtue of getting a large percentage of its revenues from that country, or having a substantial share of its manufacturing located here, would have a higher lambda value than a company that is less exposed to that country. Many investors and researchers use country risk premia to adjust the estimations of expected returns by using the capital asset pricing model. However, some of the researchers object from using the country risk premium. They say that the global CAPM would capture a single global equity risk premium, relying on the asset beta to determine volatility. A final major argument rests on the belief that the country risk is better reflected in the company's cash flow than the utilized discount rate. Adjustments for possible negative effects within a nation, such as political and/or economic instability, would just be worked into expected cash flows, therefore eliminating the need for adjustments elsewhere in the calculation. Finally, another method for estimating the expected returns is based on the figures from the local market only. This is called the local CAPM. In this sense, investors don't have access to opportunities associated with international diversification of risk. And this implies that the capital markets of individual countries would be completely segmented from an international perspective. According to this type of the capital asset pricing model, the beta is measured relative to the country's market index, and the equity premium to be used is the local market premium. Of the major weaknesses of model is that it doesn't tackle the issue of currency risk, though it does exist in the real world. There is a number of other modifications of the CAPM which are used in practice and in various empirical studies. We can use these modifications to make a better estimation of expected returns. However, we need to remember that all these modifications of the CAPM are based on empirical findings and do not have the theoretical background as the general capital asset pricing model has. The capital asset pricing model is a formal, theoretically derived model used to estimate the expected returns on stocks and portfolios based on their sensitivity to the market risk premium, with the sensitivity ratio equaling beta. However, we also got to know that the capital asset pricing model is not the best model used to estimate the expected returns, especially at emerging markets. In this lecture, I would like to provide the theoretical framework for an alternative way to explain the relationship between risk and returns based on factor models and arbitrage pricing theory. I will start with introducing the simple single-factor models. Then I will generalize that to multi-factor models, and then we'll formally derive the arbitrage pricing theory, which is the underlying theory used to explain the relationship between the expected return on a stock and its factor sensitivities. Finally, I will also say a few words about the approaches used by researchers and market practitioners in order to determine the risk premia and factor sensitivities. This is the formula of the basic single-factor model used in order to determine the return of a stock. Please note that now we're talking not about expected return, but about a single period return, which is the unknown in this equation. And the parameter which helps us explain the variation of the single period return of the given stock is the change in the factor value, which is the only factor which may help us explain the relationship between risk and return in this world. This factor is supposed to affect all stock returns at the market, but with different sensitivities. Stocks that have small values for this parameter will react only slightly as F changes. However, when the sensitivity is large, variations in F cause very large movements in the return on stock I. Sensitivities expressed as B in this equation can be either positive or negative. That's very important, that F is not the value of the factor itself, but its deviation from the mean. In other words, that means that once the deviation from the mean in the current period equals 0, then the stock return in this very period should equal its expected return, which is the A parameter in this single-factor model. And this will only be valid if the idiosyncratic or random return in our case will be equal 0. Let me say a few words about this parameter. Random shock, also known as random error or the idiosyncratic return, is assumed to be uncorrelated across different stocks, and an important property of the idiosyncratic component is that it's also assumed to be uncorrelated with F, which is the common factor in stock returns. From the economic point of view, the idiosyncratic return is the part of the overall return in the single period, which is caused by some random effect and is not explained by the model. However, the sum of the first two parts in this equation contribute to the return which is explained by the model. And indeed, we can prove that this model is valid once the expected value of the idiosyncratic return equals 0, which is generally the case for well-diversified portfolios. Starting this point, we will omit the idiosyncratic component in our formulas and will assume that all the stocks we're working with are treated as well-diversified portfolios. Now let me provide the example of how we can apply a single-factor model in order to calculate the returns of stocks and portfolios. Let's assume that we have two stocks in the market, X and Y, and their returns can be explained by a linear single-factor model. For stock X, the expected return is 8%, and the sensitivity to the factor specified in the model is 0.5, while stock Y has the expected return of 12%, and the sensitivity to the factor equaling 2. Now let's question ourselves. How can we represent the equation for the return of the portfolio which has stocks X and Y equally weighted? In order to do that, we will need to have the weighted average of these right sides of the factor equations put together, just like shown on this picture. And hence, the portfolio which contains stocks X and Y equally weighted is assumed to have the expected return of 10% and the sensitivity to factor F equal to 1.25. This is very important, as now we can assume that we can change the weights of stocks X and Y in our portfolio to replicate the portfolio with any desired sensitivity to factor F. For example, we can create the factor replicating portfolio which has the sensitivity to factor equal to 1. For this reason, we need to solve the system of two equations with two unknowns. The first equation is the one for the target sensitivity, which has been set equal to 1, as we're looking for the pure factor replicating portfolio. The second equation corresponds to the fact that the total weight of all assets in our portfolio should be equal to 1. As this is the system of two linear equations with only two unknowns, it's assumed to have just one solution, which is right here in front of you. So the portfolio, which contains 2/3 of stock X and 1/3 of stock Y, is indeed supposed to have the sensitivity to the factor change equal to 1, and the expected return of this portfolio equals 9.3%. We can do just the same thing in order to replicate the portfolio which has no sensitivity to factor F. The only difference here is that the target factor sensitivity to F should be equal to 0. This equation also has just a single solution. The weight of stock X in such a portfolio should equal 4/3, and the weight of stock Y should equal minus 1/3, which implies that we need to short sell stock Y in order to create such a risk-free portfolio. And we can easily check out that indeed the portfolio of stocks X and Y in the given weights will have zero sensitivity to factor F, and its expected return will be 6.7%. Now let's summarize what we have found out. As we see, the expected return of the factor replicating portfolio equals 9.3%, while the expected return of the risk-free portfolio equals 6.7%. This gives us the opportunity to work out the factor risk premium for the factor specified in the model, which will equal 2.6%. From the economic point of view, the factor risk premium will equal the reward for the additional risk taken by an investor who prefers to invest in the factor replicating portfolio, other than investing the money into the risk-free assets. Let's remember this while we proceed to the more general case of the multi-factor models. Financial markets are complex, and indeed, as it frequently turns out, there is a big number of factors which affect the returns of stocks and other financial instruments. So that's why now it's time to generalize our previously discussed single period model to a bigger number of factors. Indeed, the factor equation for the return on a stock I, whose return is determined by more than one factors, will look pretty much the same, except for the thing that now we have n factors, and each factor has the sensitivity b, which determines the relationship between the change in this factor and the change in the overall return on this stock. Just like before, we assume that the idiosyncratic return on this stock will equal 0 in expectation. Starting this point, I believe it's easier to explain the concept of multi-factor models based on an example. So that's why let me introduce the following situation to you. Suppose you work as an analyst in the research department of a bank and you hired a team of junior financial analysts with exceptional background in macroeconomics in order to determine the factors that affect the returns of stocks A, B, and C. Your team have studied the empirical data for the last 10 years and come up with the following linear two-factor model. Let's assume that the idiosyncratic stock returns are insignificant and short selling is allowed for all stocks. Now you need to do just the same job as before in order to identify the returns of the factor replicating portfolios. However, now you have two factors that affect stock returns instead of one, namely the change of the consumer price index and the change of the GDP growth rate. On the first stage, let's replicate the pure tracking portfolio for CPI, which can be defined as the portfolio which has unit sensitivity to the change of the consumer price index and no sensitivity to the change of the GDP. For this reason, now we need to make the system of three equations with three unknowns, with the first equation being the one for the target sensitivity to CPI equaling to 1, the second one being the equation for target sensitivity to GDP equaling to 0. And the third one, as usual, is the total weight of all stocks A, B, and C, which should always be equal to 100%. This system has the single solution, and the weight of stock A should be minus 200%, the weight of stock B should be 100%, and the weight of stock C should be equal to 200%. It's easy to make sure that this portfolio will have unit sensitivity to the change of CPI and no sensitivity to the change of GDP, and its expected return will be equal to 11%. On the next stage, we do just the same job in order to replicate the portfolio, which will have unit sensitivity to the second factor, the change in GDP, and no sensitivity to the first factor, the change of CPI. Practically, we do just the same job, with the only difference are the target sensitivities of these two factors. Now, as you see, they have changed place. And again, this system has just a single solution, and we should short sell 150% of stock A while having 100% of stock B and 150% of stock C in our factor replicating portfolio, which will have the expected return equal to 14%. Finally, we need to determine the weights of stocks A, B, and C in the risk-free portfolio, which is the portfolio that has no sensitivity neither to the change of CPI nor to the change in GDP. And again, this system has just a single solution you can see in front of you, and this factor replicating portfolio with zero sensitivities to both factors will have the expected return equal to 3%. Now we know the expected returns of the two pure tracking portfolios for CPI and GDP, as well as the expected return of the risk-free portfolio. And the risk premia for CPI and GDP are 8 and 11% respectively. Now let's summarize the key definitions and takeaways that we have made up to this point. First of all, we have introduced the concept of the factor replicating portfolio, also known as the pure tracking portfolio, which is the portfolio that has the unit sensitivity to the given factor and zero sensitivity to any other factor specified by this model. At the same time, the risk-free asset is the asset or portfolio that has zero sensitivity to all factors specified in the model, which makes the difference between the definition of the risk-free asset in the framework of the factor model compared to Capm, for example. Please note that it doesn't mean that the risk-free asset should have no sensitivity to any given factor in the world. However, once this factor has zero sensitivity to all the factors specified in this very model, we can treat it as the risk-free asset. Finally, by the risk premium related to the given factor, we consider the additional reward or the extra return associated with investing in a factor replicating portfolio in comparison with the risk-free asset. It's important to note that once we are doing with an n-factor model, we need at least n+1 stocks in order to determine the factor risk premia and the risk-free rate. Having listened up to this point, you may still have a question. Why do we bother calculating the factor replicating portfolios and estimating the risk-free returns? So what's the main purpose of that? The answer is that we need these estimations in order to explain the relationship between the expected return on the asset and its factor sensitivities. In other words, this is an important step towards the derivation of the average pricing theory, which I'm about to show you. Now let's assume that you have only three possible assets to invest in. The first one is the factor replicating portfolio with the relation to the consumer price index. Another one is the factor replicating portfolio in relation to the GDP. And the third one is the risk-free portfolio. The return equations for all these three portfolios have been derived before, and we know them. Now, our task is to replicate the payoff on stock A using only these three assets. As we know, stock A has the sensitivities to the change of CPI and GDP growth rate equal to 1. Let's make the portfolio with such weights of the CPI and GDP factor replicating portfolio, and the rest will be the weight of the risk-free portfolio. After that, we can work out the factor equation of the synthetic portfolio which will replicate stock A, which is indeed the weight of the portfolio replicating CPI plus the weight of the portfolio replicating GDP plus 100% minus the two weights of these portfolios multiplied by the risk-free rate, which will actually replicate the factor equation for stock A. And at this point, I would like to state the most important thing in this lecture. For the absence of arbitrage, we assume that all assets with identical factor exposures must have equal expected returns. That means that the synthetic portfolio, which contains two-factor replicating portfolio and the risk-free asset, should also have the same expected return as stock A, which has the same factor exposures. Otherwise, it would be possible to make an arbitrage transaction and gain unlimited profit. Now we can look at this model with respect to expected returns. As we know, the expected return of the CPI factor replicating portfolio equals 11%, or 8% plus 3%, which is equal to the appropriate factor risk premium plus the risk-free rate. We can say the same about the expected return of the factor replicating portfolio for GDP, which equals the GDP factor risk premium plus the risk-free rate. As it follows from the formula of expected return on a portfolio, it should be equal the weighted average return of all the assets which contribute to this portfolio. In other words, that will be the weighted average of expected returns of the two-factor replicating portfolios and the risk-free asset with the weights of 100%, 100%, and minus 100% respectively. Now we can rewrite this equation with respect to letters, having the total equation for the expected return of these assets, which will be equal to the risk-free rate plus the sensitivity to CPI multiplied by the factor risk premium plus the sensitivity to GDP multiplied by this factor risk premium, which will be the equation known as the APT, or the arbitrage pricing theory equation. This equation helps us estimate the expected return of any stock available in the market which is exposed to the factors of risk specified in this model. And again, this equation implies that all assets in the given market whose pricing follows this model should have equal expected returns if they carry equal sensitivities to the given factors. Note that the APT equation can be used to test the factor model. This equation states that average returns on assets are higher if those assets have higher factor loadings. The factors are the same for all assets. This is a cross-sectional statement as it compares average returns for different assets. In other words, we can regress average returns on assets in excess of the risk-free return on the historical sensitivities of these assets. Note that here B is the regressor, not the coefficient. If the factor model performs well, then the intercept of this regression should be close to zero. Now let's compare the equation for the factor model we discussed earlier with the arbitrage pricing theory equation we derived based on that. As we can see, they have pretty much in common because they use just the same variables. A, which is an expected return in the factor model equation, corresponds to the expected return in the APT. The factor sensitivities for the factors specified in the model are just the same both in the factor model equation and in the APT equation as well. The only thing that makes the difference is the purpose of use for these two equations. Once again, we use the factor model equation in order to determine the single period return based on the deviation of the given factors from their mean values in that particular period. However, APT is a more general look at the problem, which we use to determine the expected return of the asset, knowing its exposure to the factors specified in the model. We can use the APT formula to test the expected returns of stocks A, B, and C in the previously considered example. As we can see, in all cases they make a perfect match, and that's not surprising because the equation for APT in our model was produced based on the returns of stocks A, B, and C. However, the most interesting thing happens when we decide to introduce one more asset in our model. For example, let's consider stock D, which has the sensitivity of -1 to the change of CPI and the sensitivity of 2 to the change of the GDP growth rate. As it follows, based on historical data, this stock has the expected annual return equal to 15%. And the question is whether this stock is priced correctly or not. First, we can apply the APT equation for stock D in order to find out that indeed its expected return based on this model should be 17%. However, its actual return is other than 17%, which creates the potential arbitrage strategy. As we can see that stock D currently shows lower expected return compared to its theoretical return predicted by the model, it's likely to be overpriced. That's why, in order to create an arbitrage strategy, we need to short sell stock D and use the proceeds to buy a replicating portfolio of stocks A, B, and C, which will have the same factor sensitivities, namely -1 to the change of CPI and 2 to the change of the GDP growth rate. So let's replicate such a portfolio. For this reason, we set the target sensitivities to the given factors equal to those of stock B and solve the system of three equations with three unknowns once again. As we can see, in order to make the portfolio replicating stock D using stocks A, B, and C, we should short sell 100% of stock A and buy 100% of stock B and C. As we can see, this portfolio with the same factor sensitivities as the ones for stock D will have the expected return equal to 17%. Now combining all these four stocks in one portfolio called the arbitrage portfolio, we can see that indeed this portfolio may produce us the annual arbitrage profit of $20 if we make trade with each security for the market value of $1,000. Or in other words, this arbitrage strategy is likely to provide us the return of 2% per annum. But potentially, this strategy can make us unlimited return if we increase the amount of trading stocks A, B, C, and D to higher volumes. But of course, these arbitrage opportunities will not last for the long time, as this is not only you, but many other market participants who track the stock returns and use various pricing models to estimate the true prices for different stocks. As all those who trade in the market will start short selling stocks A and D and buying stocks B and C at the same time, the prices for stocks A and D will be likely to drop in value. At the same time, the prices for B and C will increase. And very soon, the opportunities of making risk-free arbitrage transactions without using your personal funds will disappear. So this is how the market works. The arbitrage pricing theory gives us a straightforward, alternative view of the world from the capital asset pricing model. Indeed, the CAPM implies that the only factor that is important in generating expected returns is the market return, and further, the expected stock returns are linear in the return on the market. The APT allows there to be multiple sources of systematic risk in the economy. Some may reflect macroeconomic factors like inflation and interest rate risk, whereas others may reflect characteristics specific to a firm's industry or sector. Here in this table, I would like to summarize the key advantages and disadvantages of using the capital asset pricing model and the arbitrage pricing theory in order to determine the relationship between risks and returns. Practically, the advantages of one model correspond to the disadvantages of the other. For example, the main merit of the CAPM is simplicity. Indeed, as we have already discussed, this is a one-factor model which have been formally derived, with the only risk factor which is specified and can be estimated easily. At the same time, we observed that sometimes this model lacks validity, especially when it comes to estimating the expected returns at emerging markets. Another problem when using the CAPM is that it's not possible to test it in a proper way, just like we discussed considering the Rawls critique of the CAPM. However, at the same time, arbitrage pricing theory based on multi-factor model generally has higher validity because it can account for various factors of risk rather than the stock exposure to the market risk premium. However, at the same time, this is a model of a higher complexity because you need to determine the factors of risk yourself. No one tells you which factors are significant and which are not. So you need to test it yourself, and practically you can never be sure that you have accounted for all the factors which contribute to the expected return of the assets you consider. Indeed, there is a broad variety of factors which may determine stock returns. And here I have classified these factors into 6 main groups. The first group of the factors correspond to the company fundamentals. Indeed, this is the most straightforward and the most understandable one. By observing the changes in the company's earnings, book value, size, dividend yield, and even the CEO characteristics, which is a new approach for research in corporate finance, we can determine the factors which are closely linked to the price of a stock. And this is quite understandable. Industry factors are understandable as well, because we know that the companies from different industries may vary because each industry is specific. That's why we need to understand, for example, what's the average industry operating margin or profit margin for all the companies who operate in this area in order to control for the variables in the previous section. We also need to account for macroeconomic factors, especially when we compare the companies from different countries and regions. So we need to account for such factors like GDP growth, income per capita, inflation, as well as currency rates and commodity prices in order to make a more accurate estimation of stock returns. So these are also the factors we need to control for in our regressions. We may also consider the stock past performance in order to forecast their future returns. We need to consider market trends in order to apply momentum strategy that implies that the stock price is likely to follow the previous trend, or the mean reversal strategy, which implies that the stock is going to reverse. We also need to take into account the liquidity factors, with trading volume and free float being the most quoted proxies, as well as the factors which account for market sentiment. This has more to do with behavioral economics and somehow help us explain why some particular stocks tend to be under or overpriced in relation to their fundamentals over a longer period of time. Indeed, different types of investors depend on different factors. For example, short-term investors and traders tend to incorporate and may even prioritize technical factors. On the contrary, long-term investors prioritize fundamentals and recognize that technical factors do not play an important role. Investors who believe strongly in fundamentals can reconcile themselves to technical forces with the following popular argument. Technical factors and market sentiment often overwhelm the short run, but fundamentals will set the stock price in the long run. In the meantime, we can expect more exciting developments in the area of behavioral finance, especially since traditional financial theories cannot seem to explain everything that happens in the market. Here are the 3 steps you need to follow if you need to incorporate a new factor into your model. On the first step, you need to understand the economic intuition. In other words, you need to provide a clear explanation why this very factor may influence the expected return of a security. Of course, that's not a problem if you consider such factor as the company's earnings. However, for other factors, this economic intuition may be less straightforward. Having agreed about the economic intuition, you need to select an appropriate proxy for this factor. Indeed, for some indicators, you can simply take the number from the company's financial reporting. However, in other cases, you may look for more complicated estimators. Finally, now that you have the proxy for the factor, you need to test it for statistical significance by running a regression. Once it appears to be significant, you can incorporate it into your model and use it in order to estimate the expected return on the stock. Currently, we have more than 100 statistically significant factors that may explain stock returns. However, the problem is that these factors may vary across industries and markets, which is even worse. Once the risk factor is recognized by the market, it tends to lose its predictive power, as more and more traders start incorporating these factors into their trading strategies. So, over time, the validity of the factors that determine stock returns may change, and this is a never-ending race. I also need to say that we have considered linear models in our today's lecture. Indeed, they tend to be the most popular ones, and more than 90% of research papers do with linear models. However, there are more complicated models which are introduced by various researchers, and they may help us better estimate the links between risks and returns once linear models do not have enough statistical significance. Finally, I would like to say that research in this area is still underway, as the econometric studies are the mainstream of the economic and financial science nowadays. So I believe that in the upcoming years we will have more factors included into the models, which will help us better explain the relationship between risk and return. In my next lecture, I will make an overview of the most popular empirical multi-factor models used by researchers and market practitioners in order to determine the expected stock returns.